Hello, investors and traders. Today's discussion will focus on high probability swing trading. We'll start by defining and highlighting key points for high probability investing and swing trading. Then we'll provide ideas for implementation in today's market. Even if you're not a swing trader, but rather a long-term investor, you can still apply the same principles we discuss. Personally, I engage in both swing trading and long-term investing. What is high probability trading? High probability trading involves taking trades with a favorable risk-reward ratio backed by positive expectations from back testing and adhering to a predetermined money management parameters. The best traders enter trades when the odds are in their favor, focusing on making money rather than simply trading for the sake of it. These trades typically align with the major trend of the market, with traders waiting for dips in uptrends or bounces in downtrends. It's crucial for high probability traders to know when to cut the losses and let the winning trades run, ensuring that losses are minimized and profits are maximized. Exit rules are just as important as entry rules, as knowing when to take profit determines overall success. While going with the trend offers the best success rate, attempting to pick tops or bottoms can also be successful if the right pattern is recognized and traders are quick to accept when they are wrong. Ultimately, disciplined trading, a solid strategy, and effective money management can lead to the success regardless of trading style. Here are some basic rules to begin high probability trading. Number one, consider multiple factors before entering a trade rather than relying on a single indicator or reason. Two, gain an understanding of how other traders are likely to perceive the market, not just your own perspective. Number three, evaluate potential risk and reward of a trade before committing capital, ensuring that the potential gain outweigh the potential losses. What is swing trading? Swing trading is a style of trading that attempts to capture short to medium-term gains in a stock or any financial instrument over a period of a few days to several weeks. Swing traders primarily use technical analysis to look for trading opportunities. Number one, swing traders may utilize fundamental analysis in addition to analyzing price trends and patterns. Two, swing trading involves taking trades that last a couple of days up to several months in order to profit from an anticipated price move. Three, swing trading exposes a trader to overnight and weekend risk, where the price could gap and open the following session at a substantial different price. Number four, swing traders can take profits utilizing an established risk-reward ratio based on a stop loss and profit target, or they could take profits or losses based on a technical indicator or price action movements. Understanding the swing trading. Typically, swing trading involves holding a position either long or short term for more than one trading session, but usually not longer than several weeks or a couple of months. This is generally time frame, as some traders may last longer than a couple of months, yet the trader may still consider them swing trades. Swing trades can also occur during a trading session, though this is a rare outcome that is brought about by extreme volatile conditions. The goal of swing trading is to capture a chunk of potential price move. While some traders seek out volatile stocks with lots of movement, others may prefer more sedate stocks. In either case, swing trading is the process of identifying where an asset's price is likely to move next, entering a position, and then capturing a chunk of the profit if the move materializes. Successful swing traders are only looking to capture a chunk of the expected price move and then move on to the next opportunity. Through the next few weeks, we will be giving you ideas of companies, securities, or CFDs, what we call perfect for swing trading. For the last 3 years on this channel, we have specifically been trading the VIX. Some years, it's been much easier to trade the VIX than others, but still, for traders, trading the VIX is easier than other securities. First of all, the VIX is a sentiment indicator. So when the sentiment gets either too high or too low at extremes, it is based off emotion. So it's easier to time this stock when it's at extreme levels than a security that might have great earnings coming out, or a new product, or in the opposite direction, some fundamental problem. So the first security we're recommending for swing trading is the VIX, Before we get started, disclaimer: for the information provided on our channel is for educational, informational purposes only and is not intended to be a substitute for professional financial advice. You need to build your own system. This is what we are preaching, for you to have 7, 8 indicators and build your own weight of evidence, your own historical factors. So let's go down and start looking at the VIX. And let's just look at recently why we say it's always a good idea to swing trade the VIX. When the VIX hit close to the 20 range on the traded CFD option, we recommended for a short-term trade to short into it. As you know, the VIX works the opposite of the market. And recently, it's gone down to 15 at the time of filming. That's close to 4 points easy you could make. Now imagine this goes down to 14. It's a pretty good safe bet that will jump back up to at least 16, if not higher. And if you go back to left this chart, it's always working out the same way, where it goes to extremes, comes back down, goes to extremes. The one point we would tell you is that if the overall market is bullish, don't fight the trend. If the overall market is bearish, again, do not fight the trend. So what do we see? And building a weight of evidence with 4 or 5 factors for you to short-term trade the VIX. We first look at extreme levels. And when we see the levels at 15.61 or 19.85, we threw in a bearish recommendation short-term. On the opposite level, a week and a half ago, when it was at 20, we threw in a bullish level. So the first recommendation is look for at extreme level. And we have reached an extreme level here, which brought us to a point to give us a bearish recommendation for our first weight. Then we go into stage analysis. At the time of filming, we found out that 73% of the NASDAQ 100 was in a declining phase. And then we go down to our short-term indicator, 17.55. Again, remember this works the opposite, and it gives us a bearish recommendation. Overbought, oversold, more bearish recommendations. If we look at the components of the overbought, oversold, we are neutral. All we're trying to do is build an evidence for the short-term swing trading with the VIX. If we continue further down, we look at the put call options is at neutral. The double AI market sentiment at neutral. What's interesting is the RIDEX ratio is bearish, and this signal worked very well to tell us to buy into it for a swing trade and also to short into it for a bearish trade. The stock price strength index is bullish. So what are we trying to tell you to build your system? For swing trading, one of the components you could use is the VIX and the VXN. The first thing that we look at is the VIX at extreme levels? And when it reaches those extreme levels, factored in with other indicators, it gives you a high percentage of succeeding. What 5 factors will you use to time the VIX? You know the catchphrase: study it, analyze it, adapt it. Peace.